Okay, ladies and gentlemen, it's me again, Kevin. But now I'm not a presenter anymore, I'm the moderator. So I understand that we are approaching the lunchtime. So probably a lot of investors here, they might be hungry. So I would like to request all the panelists here to keep your answer short and precise. Okay? So for the investors, if you do have any question, feel free to key in your Slido, and I will address the questions to all the panelists here. And coincidentally, this is the first time being a moderator, I have the panelists for different regions. We have Mr. Philip, we have Mr. Philip from US, Mr. Ken from Hong Kong, Mr. Christopher from Malaysia, and Mr. Connor from Japan. So if I want to wrap up the entire key investment teams in the year of 2025 in just one word, I would request all the panelists here, which word would you advise to the investors? I will start from Mr. Philip.
In one word.
In one word. Which are the key investment team that you shouldn't ignore?
That's a really tough question. I would say cautious might be one. Just really quickly, risk on equity markets continue to run, but you need to be a little bit cautious.
Cautious, right. Mr. Ken?
Opportunistic.
Opportunistic.
The fact is that regardless of where we are today, right, the fact potentially is that interest rates might still be at elevated levels, at least for the foreseeable future, then you have to be a bit more opportunistic as to how you can invest, right? If we look at Asia, we look at opportunities in this part of the world, potentially you look at where there's gaps in valuations or where there's gaps in terms of where markets are priced and kind of what are the opportunities that these markets can present itself. So I think investors this year can be very opportunistic, not necessarily investing in everything, because last year, a lot of the markets, both equities and fixed income, were positive. This year, probably be a bit more opportunistic as to how you can continue to achieve positive returns in 2025.
Opportunistic. Well, Mr. Christopher.
That's fine. I think for me, unexpected. I think if there's one thing in markets we can be sure is that anything can happen, and it probably will. So I think this year will be a year of surprises as well. And I think the key is that we must be ready to take the opportunity when the time comes. When there's a market dip, if you believe in the long-term potential of the market, you need prepared to actually deploy capital. Of course, it can be the hardest thing psychology to do, but I think that's one thing you need to be prepared to. And number two is to also hold a diversified portfolio, right? Because you never know, which region or which country or which sector might do well at certain different times of the year.
Okay, Mr. Kono.
Yeah, that's okay, thank you. For Japan is definitely the one of the area we will keep investing. As I mentioned earlier, for that finally be revitalized from the last decade. And also, we had the volatility in the last 6 months because of the rate hike and also the election in Japan too. So that is still a good time to consider the investment. And I can disregard other markets, but Japan is definitely one of the areas to invest.
Okay, so if I want to wrap up the entire ideas shared by all the panelists, I would say that this year is likely to be volatility, but it also comes with opportunity. And since that, next week we're going to witness the inauguration of Donald Trump. So as we have different regions, experts from different regions here, I would like to also start from Mr. Philip. Can you comment a little bit from the US perspective, followed by Mr. Ken from Asia, including Hong Kong and China and India, Mr. Christopher from Malaysia, and Mr. Connor from Japan. What are the biggest impact and what are the risks or opportunity that you should observe, followed by the inauguration of President Donald Trump?
So I think the first thing to note would be, regardless of whether, what your opinions are on Trump or his policies, they are looking to be fairly stimulative to the U.S. economy. Tariffs aside, but if you're looking at the deregulation that he's looking at improving, should be positive to technology, positive to financials, positive to utilities. So broadly speaking, from an administration perspective, I think to the U.S. economy, he'll be broadly supportive. I'd say tariffs and the trade policies that he's looking at might be a little bit more of a concern. But something that we all know about Donald Trump is that he likes to make deals. He likes to market these deals that he has. And so I think what the administration incoming will do over the first couple of weeks, first 100 days, will be providing a little bit of clarity as to what that means for both the global economy as well as for the U.S. economy too on the tariffs and Trump side, trade side.
Tariff and deal. Seems like it's going to be tough for Mr. Ken. How do you address that?
No, the thing is that our assumption right now is that, again, looking at China per se, China we expect to see growing at 4.5% with the assumption that we get a 20% tariff hike. We get specifically, Chinese government with their fiscal deficit will run at roughly around 4%. Also assuming that the Chinese Central Bank, the PBOC, will lower interest rates by roughly around 30 to 50 basis points. That's kind of our base case scenario. A lot of the negatives, I would say, has been mostly priced into a lot of the Asian equity markets. If you look at so far in 2025, we've had a couple trading weeks already, and a lot of the markets, aside from Korea, has been, sort of have seen a bit of pullback. Assumptions are potentially, maybe having a stronger than expected dollar, because the Fed might not be lowering interest rates as quickly as anticipated, does have an impact on Asia, at least in the near future. But all that has been priced in, right? As I mentioned earlier, it's not about investing what happened previously or even what happened yesterday. It's more about what's going to happen on Monday and beyond. And if a lot of these expectations have been priced in already to some extent for the Asian markets, that's why when I said earlier, be opportunistic. Look for opportunities that's out there, because there are plenty of opportunities here in Asia, especially when we talk about, whether or not a market is inexpensive, attractive valuations. There's a lot of that out there. And that's why, I strongly do emphasize that China is a great opportunity. And even India, because of some of this pullback, do have merits as to where we can look for opportunities when it comes to, investing in India.
Mr. Christopher?
Right, I think from Malaysia's perspective, I think the biggest impact to our market would be the AI export controls, which was actually proposed 2 weeks ago and has impacted the market. But I think I urge investors not to be too bearish on this. I think if one thing Trump is known for he's known for making deals. After all, he wrote a book called The Art of the Deal. So I think it's very possible that he makes special arrangements with certain countries or certain presidents that he likes, and they come to an agreement as to what can or cannot be exported. In fact, yesterday he actually tweeted that I had a very friendly conversation with President Xi Jinping, and we will work together on many issues. And after that, the Chinese stocks listed in the US had a rally. So I think anything can happen this year. So be ready to take advantage of opportunities when there's a sell down. And also you need to look at the fact that a lot of these AI data center investors in Malaysia are actually US based. So I mean, the biggest investors here are actually Google, Microsoft, Oracle. They are US hyperscalers after all. So actually there is no incentive for US to actually kneecap their own companies. So I think this is one thing that we need to watch out for.
Okay, great. Mr. Kono?
Yep. So regarding the Japanese market, again, we are basically the positive, especially on the domestic demand driver, and because the external driver are fluid, including the Trump one. And regarding the Trump 2.0 potential impact of Japanese the market, there will be both of the positive and negative. So let me give the one example. For automobile sector, this is the largest sector in Japan. And let's say the Honda, second largest automobile manufacturer in Japan. So they no longer exporting the goods from Japan to United States. 100% of their vehicles to be sold in United States are produced in United States. So there will be no impact from the tariff, even if the Trump will raise tariff for Japan. And Toyota, 70% of the US vehicles are now produced in United States itself. But left 30% coming from the Mexico now. So if Trump increases the tariff for Mexico, that will be the partial negative impact on Toyota. So Honda will have the benefit because they will have the price competitiveness in United States market. Honda, Toyota farm, and some other market, some other automobile company, there is a variety of the exposure in United States too. So there is both the positive and negative, and we should choose positive one.
Right. Domestic demand. And Mr. Kano, actually, I do witness another question regarding to the Japanese yen. Well, the question is asking, will the Japan market still be exposed to yen carry trade like it was happened in the last August? Do you expect something like Black Monday, like what we experienced in a couple of months ago, happen again?
Yeah. So we still expect JPY will somewhat appreciate in the next 2 to 3 years. That's because Japanese economy is now revitalized. So that's a good thing. For overall, when it comes to the JPY, it's happening just because Japanese economy is now recovering. And that's associated with the BOJ rate hike, so that's a direct driver. But the key driver is, again, economic revival. And for currently the JPY is too cheap, some having the benefit from the JPY depreciation, but importers are there too in Japan. For importers have the potential benefit from the JPY appreciation in the future too. So again, this is also the area where there will be the winner and the losers, and that's also one of the reasons why we focus on the domestic demand-oriented industry, because they will tend to outperform the market during the JPY appreciation period.
Yen is cheap. If you want to visit Japan, it's the time. Okay, apart from what happened a couple of months ago, let's say, again, Mr. Kono, if investors already bought into Japanese market and he's trapped at a peak, what should he do?
Oh, sorry, it already peaked?
Yep, he bought at the peak somewhere around, I think, first half of 2024. If already bought, and since the Japanese market experienced slightly a sell down, what should he do?
Oh, okay. We are here in Malaysia. Let me address this, starting with the JPY again. So this is also important, especially for the short-term trade. So when JPY appreciates, topics for Nikkei 225 tend to decline. That's mainly because we are looking at corporate earnings in JPY terms. So again, Honda, I talked about the United States market, automobile, but Honda entirely, they no longer exporting any vehicle from Japan to anywhere, any other country. So that means even if JPY appreciate, their price competitiveness in the overseas market won't be changed. But market usually react to the JPY volatility just because we're talking about corporate earnings in JPY terms. So they earn the money in United States or somewhere else and convert to JPY. So that's of course what we usually do. So again, most important part is when JPY volatile and then stock market also got volatile, it could be the best time to invest because that should be just a short-term trade impact on the equity market. Carry trade one, that's also the same. So that's short-term trade,
Right.
not
Best
long-term.
time to invest.
Yeah.
Okay, Mr. Ken, Chinese market do experience a sell down as well. Let's say if the investors bought at peak, what should he do?
Well, there's only, if you look at last year, they would have bought peak at the end of September, and then there's been a bit of a pullback. The fact is that the pullback hasn't been fairly that big either. And so when we talk about sort of investing, a lot of times, especially when it comes to investing in China, the fact is that it's off of its highs even from a few years ago. So we're nowhere near where we are. You're really, even that blip that you saw, you're still at multi-year lows from where we are. So the fact is that where we're at right now, I would advise clients to look at the market positioning, continue to add on into sort of that weakness, and wait for the opportunities, especially if we do see those policy supports coming from the government. And again, that's why the great thing about China-India Fund, when there aren't opportunities that present itself in China, what we'll do is focus on certain thematics, high yields, focus on specifically certain IT-related or AI-related, where CapEx, or what we call capital expenditures, have been being very accommodative. And then, have a bit more exposure then towards India, where there might be better opportunities. So that's why having a China-India solution makes a lot of sense, because you do have options in terms of how you deploy capital.
Mr. Philip, this question is going to be easy for you because I think US market is did pretty well. Next question, can it become better?
I think the US market has done well. I think looking back, you'll see that. I think looking forward, the prospects are still quite bright, right? As I highlighted in my earlier presentation, the US economy continues to be the strongest amongst developed market economies. It continues to support global growth. It continues to grow as a proportion of the global GDP and global economy, global market cap as well. I'd say while we see some beginnings of cracks in the economy and beginning of cracks in some sectors in the US, earnings growth is still strong. Corporates are still seeing earnings, seeing revenue, strong balance sheets and cash flows coming in, and households continuing to feel relatively wealthy. All are positive for US equities coming into this year. Volatility, I think, has been a theme for a lot of the speakers this morning, to expect a little bit of volatility. But broadly speaking, we're seeing positive fundamentals.
Meaning that not a bubble.
Positive fundamentals would belie that this is not necessarily bubblish yet.
Positive fundamentals, great. Mr. Christopher, KLCI, do you expect it could go higher?
Right. So I think the KLCI did well last year, but I think this year we'll see a broadening out of the investment teams into smaller caps. I think last year, if you see our large cap funds like Kenanga Growth recorded, I think one of these record performances, driven by key index-linked stocks. I think this year will be more of a broadening team. We'll see the mid-cap space, the small-cap space start to pick up as well as the construction contracts start to go into the second and third liners. So typically what happens when an infrastructure project is announced is that, the big contractors will get the award first. So you saw the construction stocks go up. Then, the second and third liners will be the M&E contractors, the outfitters, the subcontractors, and these are all mostly small caps. So I think this year we have better prospects for actually a small cap.
And I find it interesting trend about all these speakers. They have been mentioning small caps, which I don't think this name is consensus during 2023. We're coming to 2025, people keep talking about small cap. I mean, maybe we can start from Mr. Philip. What are the main drivers of driving all this? People are starting to talk about small cap.
I think there's a few drivers, right? Post-election or leading up to the election, I think you saw both political parties talking about need to continue to support small caps. Where actually we see some cracks in the US economy have actually been in the smaller cap sector. We talked about lower rate cuts, fewer rate cuts in the US this year. And the segment of the economy that's really going to start to feel that and is starting to feel that is the small cap sector, right? Their borrowing costs are floating rate, and therefore they're servicing higher and more expensive debt and have been doing so for the last 1.5 to 2 years. So there are some struggles there, but we do think that small caps present an interesting opportunity. They're not as expensive. The chart that I showed up earlier, large caps are at 99% expensive relative to their own history, whereas small caps are in the 60s. In terms of valuations and range. Additionally, you've got a lot of variety in small caps in terms of the types of companies, the level of debt servicing, and the last point would be that small caps are more than 80% exposed just to the domestic economy. So if you're looking at US small caps and you're worried about trade wars or international geopolitics, small caps presents an opportunity to be exposed to the US economy, US businesses that are US focused, leveraging that strong consumption base from the underlying consumer and strong corporate balance sheets that you're seeing in corporate earnings.
All right, great. I believe that for the entire presentation, we can conclude with a very simple word, broadening the opportunities. Meaning that this year, probably we can expect more from those sectors that relatively underperform compared to the large cap in the year of 2025. But again, come with uncertainties, but also with opportunities. We are really short of time, so probably I will just request every panelist here, maybe you can give just one last advice for all the investors here about how do they navigate a journey in a 2025, just in a very quick way. We can start from Mr. Connell.
Okay. Just quickly, don't be biased what we saw in the last 10 years. The market environment is changing for normalizing the interest rates and also geopolitical risk, etc. So reset the mindset and focus on which country having the strong driver, especially the domestic driver is more important today because of the fluid external environment.
Don't be biased. Japan is good. Mr. Christopher.
I think this year advice is to be prepared to take advantage of volatility. I mean, is easier said than done, of course, but I think if you're prepared psychologically to, take advantages of market dips, to buy the dip, I think then that would be the most profitable opportunity in the long term. After all, we know that long-term markets go up, and for us, we are stock pickers. We believe that by picking the best companies, these are the companies that will survive and thrive despite volatility. So this year we expect volatility, but be prepared to take advantage of it.
Profitable opportunity. Mr. Ken.
Buy low, sell high, right? But again, in some instance, buy high, sell higher, right? Okay, in this case, China, you're probably buy low, sell high, right? Because of where we are today from overall, valuations and how the markets have just underperformed in the past few years. In the case of India, I say buy high, but you can sell higher, right? We've gone on this multi-year run, similar to kind of what we've seen in the US. And the fact is that people talk about, yes, India's a little bit expensive at 24 times earnings, but then I give a very good illustration, like what I mentioned earlier. China, 20 years ago, you look at A-share markets, they traded at 45, 50 times earnings because of, what people were chasing for growth. So at this point, at 20 some odd times, it's actually, it's a little bit high relative to its own history, but relative to what we've seen previously when people were chasing for those opportunities, it's not that high. So that's why I say buy low, sell high for China, and buy high and sell even higher.
Sell higher. Okay, Mr. Philip.
I wouldn't disagree with anything that anybody said, but I might focus a little bit on don't forget what your core portfolio allocation should be for the long term, right? Take advantage of opportunities, but remember, investing is for the long term as well as being able to take advantage of opportunities. So make sure you're committed to your strategic allocation, taking advantage of opportunities, and that commitment to your strategic and your core should help enable you to manage through some of the volatility that you might see in the beginning of this year.
Long term. Okay, before we end our panel discussion here, since we are approaching the Chinese New Year in Malaysia, I would like to invite all the panelists here, using our native language, to send a wish to all our investors here. Since Mr. Christopher, you are the only Malaysian on this stage, probably you can start first some wishes, then probably you can end some with Happy Chinese New Year.
Okay, it's unexpected, as I mentioned. But I'll try my best, but I'll do it in English since my Mandarin is 6:30. So Happy Chinese New Year. May this year bring good prosperity to all of you, and may you achieve your investment goals.
Mr. Ken.
Obviously from Hong Kong, so I'll do Cantonese, but 恭喜發財。咁就希望大家今年蛇年行好運，咁可以繼續有非常之好嘅利潤俾大家。
That's a fluent Cantonese. Too bad I'm from Penang, so I can't understand Cantonese. But should be the good word, I guess. Mr. Philip.
我而家係香港人啊，所以我都識講廣東話啦。所以恭喜發財，身體健康啊 ！Happy Chinese New Year and best wishes for the year of the snake. So.
All right. Mr. Kono.
Yes.
Definitely it's going to be excitement for your Japanese.
Yeah, for Japanese, we should say the yoyo toshio. So yoyo toshio means that have a great new year. So that usually you can say to Japanese, and that's simply the great year for you. So thank you.
All right, thanks everyone, and thanks for all the panels here. Thank you.